Welcome to Certified Credit's Talk Data to Me podcast, where our FCRA certified experts help you tackle the latest regulations, emerging trends, and unique challenges of the mortgage industry with an intuitive, people-first approach. And of course, data. Because your business is built on more than just a score. Visit certifiedcredit.com for more information. Certified Credit helps you hone your best practices from lead generation to post-closing QC and everything in between.
This is Elizabeth Lang-Barton of Certified Credit's Talk Data to Me podcast. And joining me here today are two very special guests. We have Jillian Sorensen, Vice President and Account Executive at Flagstar Bank. How are you, Jillian?
I'm wonderful. Thanks so much for having me.
Thank you for being here. We also have joining us today, Nate Clear, the National Sales Manager of FirstFunding. How are you, Nate?
Doing great. Thanks for having me.
Yeah, absolutely. We're excited to have you here. And as always, we have a certified credit team member, Paul Robinson. Paul is our Vice President of Sales. How are you, Paul?
Good. How are you, Allie?
Good. Thanks for joining us today.
Thanks for having me.
So guys, today we're having a very important discussion about undisclosed liabilities and repurchase demands. And we know that from your experience, there has been a couple of hiccups along the line for brokers that are going through the process of underwriting. You know, they may not have that credit refresh at the end. There may be an issue with an undisclosed liability. So let's just start at the beginning. When evaluating a borrower's ability to repay their mortgage, it's critical for a lender to assess the risk of each mortgage that's originated. But we also know that this issue not only impacts the lender, but it also impacts brokers and non-delegates. So Nate, from your perspective, let's just start with the basics. What is considered an undisclosed liability or debt?
Yeah, it's pretty straightforward. It's inherent in the name. So it's essentially any debts that the borrower has outside of what was originally disclosed at the time that the application was taken. So just because you had X debts today when you originally took your application, any additional debt that you take on during the underwriting process of that loan, all the way up to and through closing, those could be considered undisclosed debts. Those are debts that you should disclose to the lender if you were the consumer taking out that loan. In that same way, that's why it's so important that brokers and lenders in any given transaction are continuing that dialogue with their borrowers so that they know that they need to disclose that to them.
So what are some examples of what you would see come through as an undisclosed debt?
Yeah, so generally what we see, and I'm certainly on the warehouse lending side, I work mostly with lenders, non-delegated correspondents. What we run into is maybe there's a credit refresh right before the closing occurs. And you know what, certainly for first-time home buyers, right? They're getting ready, they're eager to close on that new home. And all of a sudden, right, I need to make sure that I have furniture to put into this new home. So what do? I run down to the furniture shop the week before I'm going to close, and oh my gosh, look, no interest for 2 years, and I've got a new $15,000 line. I can get my house fully furnished. That all seems well and good, but then the credit refresh happens before closing, and they go, oh my goodness, either you need to take some of this furniture back, or we need to pay this down pretty quick. Because what happens is that debt to income ratio may not still allow them to qualify for that originally intended product. And so now we're delaying closing, and we may not be able to get pensions, those kinds of things. And that seems to be something that pops up. For whatever reason, people decide after they're going to close, they're going to go on vacation, then they book airline tickets or whatever. There's just a whole slew of things that can not necessarily completely muck your credit up, but cause you to no longer qualify for that loan program. Certainly if we're kind of fitting that credit box.
Yeah, I think, Jillian and I were talking about this and some of the challenges that she's seen throughout her experience, as well as some of the other professionals at Flagstar. And so, Jill, turning over to you, I think, we talked a little bit about how undisclosed liabilities are this leading cause of repurchase. And Nate, you hinted at that when you were talking about, hey, you might not qualify. So we're talking about when we get to that portion of the loan's been funded, And then there's that repurchase demand. It's probably neck and neck with the employment termination, whether it's voluntary or involuntary before closing. So Jill, in your experience, have you and other professionals you've worked with seen this impact brokers and non-delegated correspondents?
Absolutely. Nate, I think, sees more on the front end, and I see more of them on the back end. And I can tell you that nothing turns an account executive's blood to ice quite like a repurchase email from, there's a department in our office that gets all of the agency repurchases. And so they send an email to the broker, the correspondent, that basically says, Freddie Mac has asked us to repurchase this loan. We've detected undisclosed debt. Can you please look into this and send us any relevant information so that we can fight this repurchase? And 50% at least of those repurchase demands are related to undisclosed liabilities. And it's never the same story. I mean, I would think it's more often furniture, but I've seen everything from one day before closing, borrower took out a $3 million commercial debt that they're guaranteeing personally. They didn't consider that consumer debt, so they didn't feel the need to disclose that to their LO. All the way down to, borrower pulls up to his closing in his brand new spanking Porsche, and he's all excited because he gets his new house today and he got his dream car, and everybody's just sitting there going, did you let your lender know?
Yeah.
I see it all, but it's easily 50% of repurchase demands is related to undisclosed liabilities.
Wow, that's
Go ahead.
insane.
Jillian, have you ever seen too, right, that clear to close is issued, it has a credit expiration in the loan file, and now we get to getting that loan even reviewed for purchase as a secondary market transaction, and now the credit's expired during that window, and now we get a refresh, and now the loan, maybe it's not even a repurchase, right? It's just that
Yes.
right now, well, we can't buy this loan because when we updated credit so that we could see that this loan still qualifies, that falls out too.
It does. It absolutely does. We've come down to, loan couldn't be repurchased because new undisclosed debt. And we find out later that the borrower signed for it the day after closing. It was after closing. So the liability the inquiry that was on the new credit report that they had to get because their old one expired, down to counting days and proving, nope, they signed here this day. That debt wasn't taken out until the day after. But the originator is responsible for all liabilities and counting all liabilities in the debt to income ratio all the way up until the day of closing. And there's really no way to effectively validate. Nope, borrower signed at 10 a.m. They didn't buy their new boat until 4:30 in the afternoon. There's no way to document that.
Right.
Right.
If originators could sit down and look face to face with every borrower and say, you will not sign or click the box that say, I am applying for any new credit, business related, personally related, even if we've gotten this one too, is, well, there's no payment due for 12 months. I didn't think it mattered.
Wow. Wow. Well, and that's really interesting too, because when we were looking at Jill and I sat down and we were doing some research, and when we looked at it, 47% of Fannie Mae's defects were associated with undisclosed debt for a new vehicle. So that Porsche scenario that you brought up earlier is real. 37% are those installment loans. And then, 14% are additional mortgage loans. So it's really interesting to look at the different areas that could be impacting those undisclosed liabilities. And I think one of the other things that we talk about when we're talking in this area is, it might not cause a repurchase demand, but it may change the interest rate on the loan. It may change the terms of the loan. And so, Jill, would you be able to go into a little bit? We talked about the other day, the new loan level price adjustments for Fannie and Freddie. And so, on that same lines, this goes into effect on May 1st. What do lenders need to know? And for those who aren't familiar with the new level pricing adjustments, can you provide a quick summary of what those are?
I mean, across the FHFA gave advisement to Fannie and Freddie that they wanted some pretty radical changes to loan level price adjustments. But across the board, there's a new line item that it says if the debt to income ratio is above a 40%, I believe that they are assessed 25 basis points across the board. It's either 25 or 37. I'm gonna have to go back and look. What that means is if underwriting clears a loan to close and it's at a 39.5 DTI, and then we find out later that the borrower opened up a new credit card with $118 a month payment, that loan level price adjustment is going to be assessed at delivery. And that could be everything from the loan goes all the way through, it gets sold, it gets rolled into servicing, it gets audited, and then they come back and they want somebody to pay the quarter because the DTI is actually above a 40%. I mean, this is coming. This is coming.
So then I guess the question becomes, who does that increase get passed along to?
It's honestly going to depend on which channel you're talking about.
Okay.
I would imagine, the lender, underwriting lender, the funding lender is going to absorb that, but probably not for long. And I think if the industry in general doesn't reduce the number of undisclosed liability, then more loans are just automatically going to be assessed that built into other LLPAs, just so lenders can protect themselves against the eventuality of Fannie coming or the agencies coming back and assessing a loan level price adjustment.
Right. That's really interesting. And I mean, speaking of Fannie and Freddie, according to their recent research, an inquiry can be associated with new debt obligations, and it's often presented on the original credit report. So that leads us to say, okay, so we're talking right now about these things that were taken out before we started this loan origination process. Now let's talk about those things that were taken up, or we were talking about after. Let's talk about before. So before we even start this process, there could be something that doesn't show up on the credit report for 30 days, 60 days, so on and so forth. But a borrower knew that they had that debt. So really, what questions should brokers be asking? And what should, non-delegated correspondents be asking before they even start the loan origination process with those borrowers to make sure, hey, there isn't going to be a surprise at closing?
I think one of the big things, right, and this is just a best practice, regardless if you're operating as a broker or even a loan officer, and certainly as a lender. A lot of general consumers don't ever look at their credit report until they're going out to take out debt. Oftentimes, even when you're buying a car, you don't even get a copy of your credit, right? They just run it quick. They tell you what your number is, and then they run it, through the financing. So it's a disservice to the borrower if you don't review their credit with them. So even if you're doing it remote, putting it up on the screen, doing a Zoom call with them, and going through line by line with them, so that first off, all the debt that's being listed really is their debt, and then second, hey, what items aren't pulling through here that you do have? Or, hey, did you take out a new car loan in the last 60 days? Maybe it hasn't been reported. We want to make sure we get everything so that we can ensure that we close on time. That would be, I think, first and foremost, a great step for all originators to take in the beginning.
I absolutely agree with Nate. I do think one of the sad parts about how few loan applications are taken in person is I think the borrower fills out most of their information, they submit it, then the originator pulls in the credit data onto the loan application, sends it to the borrower. I think once the borrower applies for their mortgage, they're dreaming about backyards and houses and kitchens and how are we going to paint the bathrooms and where's the nursery going to go. And I don't necessarily think that they're focused on accuracy of their loan application data like we are. That's obviously everybody in the industry. We care about data, but I don't necessarily think that loan officers typically go over every single liability and every single inquiry on the borrower's credit and loan application before it's submitted to underwriting. So I really think if a loan officer took the extra step of 5 minutes of going through each of the liabilities, do you still have this car payment? Which car payment goes with this liability? And I see it all the time where they use the last 4 pages of the credit report where it lists out the inquiries and there's a place to handwrite it, and said, was looking at cars.
Yeah.
And
Are they done?
result?
Right.
Well, and I think, Jillian, you made a great point. You talk about the last 4 pages of the credit report. A lot of our customers don't understand we can move your liabilities to the top of the credit report. So you don't have to shuffle down through all the zero balance information just to get to the pertinent information there on it as well. And so little changes like that to formatting your credit report can make a big difference. Start with your credit scores, then have your liabilities or your inquiries, then go to your derogatory accounts, then go to your open accounts, then go to your close. That's what makes our credit reports, and working with the Meridian Link platform, we have endless possibilities to format credit reports. But it's a simple change because it costs them zero money to do it. It's just
That's genius. I didn't even know that was available. Yep. That's genius. So they can tell you what they want to see first.
Exactly. Yep.
Wow.
You can format it basically any way you want. And I think that's true for most credit companies out there.
That's cool. That's a service. I wish more of my customers would do that, so that when I'm looking at the credit reports, the only thing anybody ever asks me about is usually derogs. So I have to scroll down, to page 8.
Well, and I don't think consumers don't look at their credit regularly. I mean, I'm sure all of us do, being in the industry, but they don't look regularly. And so, I mean, there could be potential fraud on there that you could help a borrower find before, you say, okay, you're not eligible for this loan product because of, it could be something else that was taken out under their name. It could be medical debt that never rolled off, because we now know that medical debt is being removed from the credit report. So I think it's important to have that review process and really get to know, what does your borrower's financial picture look like? What does their credit history look like? And help them make smarter decisions when it comes to that, especially during this quiet period from when you get, that initial pre-approval to whenever the loan is underwritten and you're clear to close. So let's say a broker, a lender, a non-delegated correspondent fails to ask these questions. Then what happens? How do these undisclosed liabilities impact the rest of that process?
Yeah, I was just going to say, I mean, it can happen a variety of ways. So, Jillian brought up loan level price adjustments based off of DTI. Well, there's even a threshold where you no longer qualify. So it's not even just being hit with maybe a quarter point of cost. The other thing that you got to keep in mind, if you're a non-delegated correspondent or you're a lender and you do have a quarter point impact, margins are extremely tight right now. So even the lender's ability to suck up that quarter point may or may not even be present, which would force the lender to increase the interest rate on that underlying loan. And that alone could also increase that borrower's ability to repay where they can't even qualify. So, we're talking about a lot of things that can impact, a broker or a non-delegated correspondent or a correspondent in terms of repurchase or loan not being able to be purchased, delaying closings. But it can have an immediate impact on that underlying consumer, that underlying borrower, and them even being able to get to the home. Right. And it all kind of comes back to, you never want to be in that position as a broker, lender, non-delegated saying, oh, sorry, I forgot to tell you this. You don't qualify anymore. And by the way, you won't be able to qualify with any other lenders either, because we're all looking at the same information. We have a lot of the same guidelines. So I think that that's the biggest thing that you don't want to, have happen to you, because let's face it, those are real estate, referral sources that are impacted, that borrowers certainly impacted, families can be impacted, et cetera. And it's something that can be taken out at the very beginning. So just because you have loan level price adjustments, those can have kind of a snowball effect into the overall ability to take out that particular mortgage. So I think that's a big point there.
After closing, when either Fannie or Freddie sends us a repurchase demand, the process is first notification. We let the originator know we have a problem here and can you please help us fix it? Surely there must be some mistake, right? Fingers crossed. So we go back to the customer and we ask them to get with their borrower and find out what happened, how it happened, dig deep, QC, help us QC here. And occasionally it has come back where they did buy that car 4 days before closing. And they signed this piece of paper in Texas where it says they didn't, you will not commit loan fraud. And it says specifically on there, if there's any changes to liabilities and or employment history, those must be, anyway, most people don't realize what they're signing. But in cases where, yes, there was undisclosed debt and no, the borrower no longer qualifies. Now we have a loan that isn't purchasable, isn't sellable. Has to either go on the scratch and dent market. I think in Texas, it's a little simpler because we do have that disclosure where the borrower specifically certifies nothing has changed. However, it does become a scramble because we now have to buy the loan back from the agencies. We have to pull the loan out of servicing, which means we have to buy it back at the same thing that we sold it for. That's a significant loss.
Right.
And then we send the originator, a little note that says, hey, you got to buy this loan back from us. If they're a good performing customer, luckily, I think we work very hard to avoid just handing them a bill, whether that's an extension to help the borrower refinance it. I've had a couple where they asked us for 45 days extension so they could tell the borrower, get this loan out of my name. So I think I've only had maybe two where they just flat had to pay off the loan, and that's frightening for anybody. But the scramble that happens surrounding that is, oh my God, what are we gonna do? It's a struggle. It's a struggle, especially for something that can be so easily prevented.
Right. So let's talk about that prevention. And Paul, this is kind of where your area of expertise is. It sounds like there needs to be that extra layer of protection. We know there are a few ways that lenders and brokers can do that. So let's just start with what we've already mentioned before, which is a credit refresh. Paul, what is a credit refresh? How does it work? How often are these being used?
Okay, no, great question. So the credit refresh report, which is probably the most widely utilized LQI tool, the loan quality initiative tool, still being utilized today, is basically a soft inquiry credit report that's pulled, typically 10 days, if not sooner, before closing there. And it's doing exactly what we're all talking about here. We're trying to see that, if there are any new liabilities, any new inquiries, just trying to see if there's any surprises, here that need to be taken care of, obviously, and see how it impacts the DTI throughout the loan. But, that was the first tool, but now, the undisclosed debt monitoring is probably the tool that's being adopted more now, because it's actually a tool that will help you be proactive, not reactive at closing. So, and keep in mind, both are pretty inexpensive tools as well. We're not talking the full price of a credit report because, everybody has really tight margins right now and the extra money goes somewhere. But honestly, UDN can be pulled, right after underwriting approval. It monitors for 120 days. So depending on how quickly that loan closes, you're still getting monitored after it's closed if you want it as well. And it's going to let you know when the borrower has a new inquiry. It's going to let you know if it was an auto loan inquiry. It's going to let you know if they have any new delinquencies. Basically, yet again, hitting that, being proactive to head these off earlier in the process than that surprise at closing that could ultimately derail the loan there. Okay. It's a solution we offer all of our customers. You don't have to be a certain, lender, non-delegate, broker. It's all tools that solutions we like to call them instead of tools for our customers.
Yeah, I think that's really interesting, Paul, because when we're talking about this proactive approach. We're hearing you get, you're 3 days out from closing and you perform that credit refresh, and it's like, oh, there's an auto loan on here. What do we do? But we know that about 81% of undisclosed debt is reported to all three bureaus. So let's say you go that credit refresh route, it's a soft pull inquiry. Does it have to be all three? Like, when you do your pre-qual, it doesn't have to be all three. Does it have to be all three for that credit refresh?
It does not. It's lender preference there. So I have customers using one bureau. I have customers that do a 3 bureau, but also do a 1 bureau UDM. So they're covering it throughout the life of the loan.
Mm-hmm.
So it's really, up to each lender and how they want to utilize it there.
I think that's really interesting, because when we look at like our own clients, on average, only about 11% of credit reports generated had a separate refresh report. So it was either that loan didn't end up closing, or there wasn't a refresh done. Do you see that as we transition more to that UDM type product, where it's more proactive rather than that final reactive pull?
I mean, that the UDMs are going to start taking up that space for sure. But I think I also hear a lot from my customers that they're only ordering refreshes on Govy loans too, so it could be the type of loan that's going on as well. Again, falling into they're utilizing it just based on the loan quality initiative from Fannie Mae, not necessarily for every loan that's going on there. So it's closed.
Interesting.
There, sometimes there's bare minimums going on out there still today. So yeah, that's why I think
I noticed your reaction.
Yeah.
Well, I mean, I have been talking with more of my customers when I'm visiting and saying, hey, you pulling credit refreshes? No, the lender doesn't require us to. You are the lender. You are the lender. Why are you, just because you're not making the underwriting decision, you are still liable for the information that you provide to your funding lender. I'm quite baffled how few take advantage of this just purely to protect themselves. We are keeping a lot of the post-closing, human capital busy dealing with this post-closing issue that is so easy to take care of up front. And one of the things that surprised me that you said, Paul, is you say they should do their credit refresh 10 days before closing. That's a lot of days to go buy a new refrigerator and a new car and a new boat and a new commercial building. I mean, I tell my customers that are non-del correspondents, you do another verbal verification of employment the day of funding, and you do your credit refresh day of funding. That way you protect yourself that there is nothing up until this moment. And I think that the cost is worth, it's like an insurance policy to make sure that your application is accurate as of the moment they close the loan, which is what the agencies require. Easy solution.
And Paul, this might not be a yes or a no, or you couldn't, but looking at these costs associated with a credit refresh, we know that it's not going to be a high cost. UDM, it's not going to be a high cost. But are these products that you can build into your closing costs and kind of pass along some of those fees to the borrower?
Oh, 100%. Yeah. There's only a few credit products out there that can't be passed on to the customer. These LQI solutions are definitely not one of them. Every single one of them can be passed on, can be put on an invoice, can be built into a credit bundle. So, you're not adding anything or losing money after the fact that you didn't disclose. I mean, yeah, this can be collected all day long.
Okay. So, now knowing that can be billed back to the borrower with that invoice and those closing costs, we're talking about UDM still. And Equifax found that 36% of borrowers who opened a new trade line during the quiet period, or that time from the initial credit pull to close, increased their debt to income ratio by 3% or more. So I'm going to go back to Jill, and we're going to talk about that LLPA grid. How would this impact that borrower or that broker? And beyond that, do you see that potential repurchase risk with, increasing to above 3% or increasing more than 3%?
Well, first of all, wow, I've never seen that Equifax statistic, but Here's the scary part that so most MI and most DU will not go above a 45% DTI. So if you have somebody who's already knocking on the max DTI door, or even let's just say they're not knocking on the top, but a 3% swing in debt to income, the MI factor is going to rise when it's as it ekes above, depending on FICO. DTI is going to depend on your MI factor. So here's a perfect example. You're 3%. So you're at a 39%. You get your clear to close. You have your MI factor as X. And let's just say Nate's story about your credit report expired. It took a few extra days to close. The seller didn't get his package back in time. So now their credit report's expired. So they repull a new credit report. Their DTI is 3% higher. The borrower already signed, the loan already funded, and now the MI factor went up, $68 a month, and there's now a quarter point hit to the LLPA. Do the math of $68 times 300 or however many months the life of loan policy. That's huge. That is a cure fee that somebody's going to have to pay.
Wow.
And if undisclosed debt is captured after the fact, after the loan has been closed, funded, sold off to investors, boarded into servicing, agencies come back and say, we've recalculated your MI. Not only did they've recalculated your LLPAs, but then the MI company is going to rescind their MI and increase the MI coverage. That is very costly, very costly.
Wow. Well, so I guess, Paul, how does UDM help avoid this? How are we taking away some of that level of concern with the UDM product? I mean, we know it monitors the life of the loan and then some, or not life of the loan, the life of the origination process and then some. But really, how does this take the place of something like a credit refresh?
Again, most likely this would have been found the issue earlier in the process and gave the company a whole lot more time to fix it before the end, before they get down and really have to take that 3% at least hit. I mean, another thing to look at there is, if it's that big of a debt to change the DTI ratio of 3%, there's a good chance the credit score got impacted too because of the new inquiry, the new proportionate balance to credit limit. I mean, there's a whole lot of stuff that could go on just with one account that does it that much. But I mean, again, kind of what we talked about, the UDMs should give you an earlier chance to react on it than that it would be with a refresh at the end, because then you're out time. Well, and especially if credit expires on the other one too, because then, at least if you catch it during the process and credit hasn't expired, you're not worried about the score portion. You're just really only worried about the DTI portion. But if the credit expires and you have to repull, the scores could readjust at the same time and have DTI issues. It's kind of a double whammy.
Good point, Paul.
Nate,
we missed that. Yeah, huge point there.
I was gonna say, Nate, what are you seeing on the warehouse lending side when it comes to credit refreshes, UDM, and how they're utilized?
Yeah, I mean, obviously, a lot of the statistics that you've listed off today are grave concern to me as a warehouse lender. We're the party in the transaction where essentially this file comes to our desk and we need a decision on it within an hour and have funds out the door. And so for us, right, the best thing that we could look to is the clear to close, when credit's going to expire, and that sort of thing, how tight are those DTIs. But in large part, it's up to investor guidelines as to what we are going to say yes or no on, right? So a lot of times we're funding these without having a clear picture on what kind of UDM policy our lenders are implementing. And that's just, part of being competitive. So generally, as Jillian was mentioning, we don't see these until the loan is not purchasable, right? So it's that the loan closed, it funded, it got, delivered over to the intended investor. The credit in that package has expired. And now we see, the collateral is being returned to your warehouse line. This loan's not going to be purchased. And now we're start working with the lender. And, just like Jillian hates having the phone call or letting the lender know, I hate receiving the phone call from the lender saying, hey, this is what happened. Where you start with, how did this happen? And were you not looking at, those key expiration dates on your loan approval? And unfortunately, right, that's the cat's out of the bag. So now we're looking at what can we do to resolve it? Is there a way that we can reprice the loan and have the loan sold? Is the borrower in a position where they're able to pay off these debts? Is there an opportunity to refinance this loan? Is there an alternate investor that may be willing to purchase these, right? Maybe a traditional MI, right, isn't going to happen, but a non-traditional lender or a scratch and dent lender looks at these as an opportunity. And the reason why they look at it as an opportunity is because they severely discount them. But if you're looking at somebody to buy a $400,000 loan back, and that would wipe out you as the lender, then hey, maybe you're looking at, I'll sell this loan at 97, 95 cents on the dollar to get rid of it. That's ultimately where kind of warehouse lending plays in, is that we don't have a lot of exposure to the UDM on the front end. We end up having to work with our lenders to kind of clean up the mess on the back end and work with secondary market investors.
I would imagine that, when you're going backwards in that process, if a lender has something like this in place, you can say, okay, well, we know that this additional debt that came up was after the fact, or we can go back and say, hey, we know that this is where it happened. This is how it happened. Let's figure out what the impact's going to be.
Yeah, absolutely. So, I mean, it really just highlights, a lot of what Jillian and I do day in, day out, is educating new lenders, existing lenders, to the tools that are available to them and why it's important that they should utilize them so that we don't end up in that situation.
Right. Well, so we're talking a lot about those undisclosed liabilities, but one of the things that you'd brought up earlier, Jillian, was that employment termination. And we know that this is the leading cause of that repurchase demand. So during the underwriting process, a verification of employment is conducted so that whether it's an VOE, an instant VOE, like a work number, or an Experian Verify, it's a consumer permission product, or it's a manual VOE. But we don't often think about that re-verification of employment. So let's talk about that re-verification of employment. What is that verbal VOE? Are there other options besides that verbal VOE?
Oh boy, where do we start to unpack that one? I think you will hear me talk about this until my face is blue. And it's not just doing the verbal verification of employment day of funding, it's doing it properly. So you would be shocked how many, processors take the phone number that the borrower put on their 1003, call them and say, you still employed. How many borrowers do you know who are buying their dream house who are going to go, yeah, no, sorry, I got fired yesterday. More often than not, when it happens during that quiet period, they either don't want to say it, haven't told their family yet, or they're still processing it and signing their name to their mortgage documents. Catching it by doing it properly. And when I say properly, I mean, you call 411 or do a Google search, get the employer's name and start calling and working your way through the phone tree until you get to HR. That is the only way, as far as I'm concerned, to do a verbal VOE properly. If I was a lender, I would be doing it day of funding on every single loan, no matter what. It's a very good policy to have in place. It protects you against the other 50% of repurchases and potential problems. I mean, I've seen a handful. I don't think any of them were with me, but where loans weren't purchased by an investor because the borrower wasn't employed when the investor went to go do a verbal verification of employment. We require a verbal the day of, closing, or as long as the borrower was employed at closing, we're going to buy the loan. But I think that one phone call, even if it takes 5 phone calls to reach the right person, just to verify that there are no employment changes, is everything. Everything.
Well, and so like talking about that, you're saying this takes place day of funding.
If it was me, yes.
Okay, because I was gonna say the Fannie guidelines are recommending a verbal E to be obtained within 10 days prior to the closing, and within 120 days prior to the closing for self-employed. So
They're going to make you buy the loan back if the borrower had any changes the day of closing.
okay.
So their recommendation, I don't really understand it, because if the borrower lost his job the day before closing, how are you going to know?
Right.
How are you going to know? If you're liable that the borrower had no employment changes up until the day of closing, why wouldn't you do it the day of closing? The day that you issue funds on that loan, why wouldn't you verify that there are no changes? I think that 10 days is for underwriting purposes. And maybe the reason of it is because if they're still employed as of 10 days, however, we all know there's a big tranche of loans that are kicked back because during that period, it's a requirement. Every loan has to have one within 10 days of closing. However, I actually sent us all a handful of repurchase verbiage from the agencies that list out how many had employment changes, whether they were reduction in force, fired, moved to another position and their income changed. And when you see these come through on a repurchase demand, I mean, they've done their research. They know that they've already done their research on their end. They're making us buy it back because of employment changes. Now, oftentimes borrower has a new job, or borrower got a new job. I mean, or, it was 3 days before closing, I got a new job. It was a better paying job. Okay, well, it might've been nice to know,
Right.
would have helped us document our file appropriately instead of scrambling after the fact. But Fannie requires 10 days. We even looked up something the other day that said, maybe do it within 3 days of closing. Why wouldn't you do it day of closing when you're liable for it?
Right. All right. So, we've hit on re-verifications. We've hit on undisclosed debt. Let's just talk about the entire lending process. When we talk about these tools, it is an extra cost. When we talk about these solutions, it's that added cost. But in each of your opinions, why are all of these solutions and steps so important to the lending process, especially for brokers and non-delegated correspondents who are not necessarily underwriting that loan?
I would just say that, and I think Jillian touched on this a couple of times during our time together today, you may not be making the underwriting decision, but you're the one that's providing all the ingredients for somebody to do that. So if you're using expired products, right, when you're building that cake, it's not going to come out so well, and nobody's going to want to eat it. So what's really important, right, is that you want to be able to deliver loans to your secondary market investors so that you maintain those relationships and you can be in business for a long time. And a lot of that, comes down to doing all the little things right, so that in the end you do have saleable loans. And I think what we're talking about here, and Paul giving us a whole ton of really good information, is that what we're finding is that it's not cost prohibitive to do. What we're talking about with Jillian and I, kind of in our back and forth, is that it's taking another 3 to 5 minutes in a process that takes 30, 45 days, right? Taking an additional 3 to 5 minutes to get it right, to have those conversations with your borrower so that you don't end up in this situation at the end. And I think it's paramount for all of us as being vendors to the industry, that we bring this knowledge to our customers, non-delegated correspondents, brokers, correspondent lenders, and just have kind of an open dialogue. Hey, what are you guys doing around undisclosed debt monitoring? What policy do you guys have in place in terms of verifying employment? And I think that just helps us all be, better stewards of this industry that hasn't always had the best reputation.
Mhm. Yeah, I think when we're talking about, you hit on a really good point there about how the industry hasn't always had the best reputation, and putting these things in place makes lenders feel, not lenders, but borrowers feel more comfortable throughout the process. I know it might take extra time, but when we talk about, the inherent distrust when it comes to mortgage lending, putting these precautions in place and explaining why they're there, hey, we're going to do a verbal view of a verification of employment on the day of closing so that we make sure that there is no kind of repurchase demand. There's no negative impact to your loan where we have to go to, get this refinanced. We're trying to make sure that you're comfortable and that you get your dream home, and that in such an emotional decision, there are those quality checks put in place. So Jillian, what are you thinking here? Why do you see these tools as pertinent to your brokers?
I mean, I wouldn't drive a car that I owned free and clear without car insurance, and I wouldn't fund a loan without verifying that there were no changes to their employment and liabilities.
Mm-hmm. I like that analogy. You guys got good analogies.
Yeah, I think absolutely, Jillian. I mean, I think that we get so caught up in what, and you run into so many situations where this is what the guidelines call for, so I'm going to do essentially these bare minimums. And you start doing that so often that you lose sight of what the original intent is. And, I think in, Dodd-Frank, right, what we're harping on is ability to repay. And so, kind of bringing that back full circle, right? That's what we're doing. That's the reason why, you're doing the verification of employment, why we are concerned about undisclosed debt, is that we want to ensure that when we do close and fund and deliver this transaction, that that the borrower does have an ability to repay. And I think, if you can take it back down to that level with, your borrower on the other end, some of them may not care, right? They're just predisposed to taking on as much debt as they possibly can, and they're going to figure it out somehow, right? But I think more often than not, you're going to have borrowers that are going to appreciate a lender that's going to say, hey, listen, we've got some checks and balances in place in order for us to ensure that there's an ability to repay here. Two of those things are the debts that you have, as well as your ability to earn an income, so your employment. So it's just structuring those conversations the right way and using the right tools, right? I think my boss, somebody I look up to, he goes, always feel free to trust people, but verify, right? And I think what we're talking about today here is that, we can have these conversations with borrowers all day. We can explain it to them, and we should, at a certain level, trust them to give us the information. We hope that people are honest. But lucky enough for us, technology is advanced in such a way that we can verify what they're telling us, and what they've reported is also accurate.
I absolutely agree with Nate. You trust and ask the questions and educate and be a trusted advisor. But in the end, take that extra step and just verify ability to repay, verify your loan quality. And then we reduce the manpower on the backside significantly, which would ultimately lower the cost of originations.
All right. So last but not least, Paul, I'm going to pass it to you. Thoughts on undisclosed debt?
Yeah, exactly. I mean, again, it's a very, very low cost solution to make sure that the brokers and non-delegates have to have an uncomfortable conversation with Jillian about repurchasing a $300,000 loan. There, I mean, we're all about solutions there, and it's really, and we know that the cost for originating loans are going up. This is not going to be those products that increase it that much, if anything. There. So I think for the little extra change in the process, it's really not much time out of anybody's day, not much money out of the pocket for that extra layer of, just certainty that, they're covered when it gets through at closing. It just makes absolute sense to me, and that there's options. You're not stuck. I'm not telling you to do one way or the other, but you have options there.
Right. Well, thank you all so much for joining me today. I really appreciate your time. For anybody who is listening to the podcast, watching the podcast, we referenced a lot of different resources throughout the show. And so in the show notes, there will be a link to things like the LLPA grid, to the Fannie and Freddie verbiage. So feel free to check those out. But Jillian, Nate, Paul, thank you all so much for being here. I really appreciate your time, and I hope you have a great day.
Thanks for having us.
Yes, thank you.
Great. Thank you.
Day.
Bye.
Bye.
Thanks for listening to Certified Credit's Talk Data to Me podcast. With over 35 years of industry experience, Certified Credit is your multifaceted mortgage solutions partner. Learn how our commitment to passionate service, innovative products, and superior technology create a more profitable and efficient lending environment for our clients at certifiedcredit.com. Certified Credit, more than just a score.